The broadcast is now starting. All attendees are in listen-only mode.
Hi, my name is Beverly Bolnick, Vice President of Sales and Marketing at NMP, and I would like to welcome you to National Mortgage Professional Magazine's webinar titled Evaluating the HECM Product, sponsored and presented by Reverse Mortgage Solutions. I would like to thank all of our webinar attendees for taking the time out of their busy days for this very valuable and informative webinar in our ongoing series of webinars. Today's webinar will be conducted by Garrett Kolb, Senior Managing Director of Correspondent and Wholesale Lending for Reverse Mortgage Solutions. Garrett joined the RMS production team in 2011 and brings 35 years of sales, management, and financial services experience. If you have questions during the webinar, please be sure to ask them in the questions area of the GoToWebinar console, and we will try to answer as many questions as possible at the end of the webinar. Also, we will be sending out the PowerPoint presentation and a link to a recording of the webinar to all webinar registrants tomorrow for your future reference. Without any further ado, I would like to turn things over to Garrett Kolb.
Thank you, Beverly, and good afternoon, everybody. And also joining us on the call today is Pat Kubert. Pat is a valued member of the RMS team, holds a CRMP designation from the National Association of Reverse Mortgage Lenders, and is a HECM DE in her own right. So get those questions ready for her because she's a seasoned reverse mortgage professional. Let's get into the agenda. So I designed an agenda that's going to allow us to quickly obtain an overview of the product, which is very, very important, the marketplace, which will kind of give us a feel for what's out there, the technical considerations that may or may not make this product apply to your organization. I'm going to admit right up front that this presentation may leave you with more questions than when you started, but I think that's a good thing. I'm going to do what I can do to make sure that we look at this from an objective standpoint. I also have more forward years under my belt than I do reverse years, and I'm kind of assuming that most of you on this call are going to be from the forward sector. So I want to talk a lot about that. We've brought a lot of clients on over the past several years that are forward lenders. Some do a great job, some don't do a great job. I'm going to talk about some of those experiences. This is not your ordinary product, okay? And I'm going to try to peel back some of the layers of the onion of this product so you get a really good feel on it. In fact, a couple of our slides are just dedicated to product only. So I'm not pitching product, but I've got to educate everybody on the product because it is complex. And because it's a complex product, it's going to bring challenges in training and origination and compliance and back office. So I'm going to start off with a kind of a brief history of the HECM on the next slide. And it's important that reverse mortgages go back to 1969, but they languished around for several decades, probably more than 2 decades. The product bounced around kind of between private and then public agencies without much of an industry to promote the product. The National Association of Reverse Mortgage Lenders was formed in 1997 and is the national voice of the reverse mortgage lending industry. It serves as the educational resource, policy advocate, public affairs center for lenders and related professionals. In fact, I am attending the National Reverse Mortgage Lenders Eastern Conference in New York City as we do this webinar. Market liquidity on this product improved big time with the entrance of Fannie Mae, who was the first group agency to securitize this, and then the product really went mainstream when Ginnie Mae came in as the primary secondary market. The industry has experienced moderate expansion during this time, and there have been numerous product changes driven by HUD to ensure not only the viability of the program, but address a lot of the public concerns about reverse mortgages that are expressed from lenders, servicers, senior advocacy groups, public concerns, and most recently, the non-borrowing spouse and, going into effect at the end of next month, financial assessment. And I kind of chuckle to myself about financial assessment because all of us on the phone probably have forward FHA experience, and our side of the industry, on the reverse side of the industry, is struggling with income evaluation, which would be part of the new requirements under financial assessment. So we'll talk more about that one. But I think financial assessment's really good for the product, really good for the image of the product, but most important, it's going to make the product align itself more with what a lot of forward lenders do today when they are offering FHA products. Looking forward into the future, we see continued expansion, more so now than ever before. The product is being driven by a growing senior demographic. We're seeing continued expansion because of the stabilization of home prices and growing equity, along with the introduction now of some proprietary products, non-HUD insured proprietary products. So on the next slide, I want to give you kind of a 40,000-foot view of how a reverse mortgage works. So at the onset of the transaction, the borrower pledges their home equity, to guarantee loan repayments. Based on the borrower's age, current interest rates, and home value, the maximum principal amount is established. Now, we've got some terminology on the reverse side that's a little different than the terminology on the forward side, what you might call loan to value or maximum loan amount. We've got some different terminology. One of them is max claim amount and principal limits. And those are really just kind of what you would suspect. Max claim amount is set as the maximum claim that a lender can make to HUD, and we'll talk more about when the property is liquidated. And principal limit is a factor established by HUD, kind of like an annuity factor, based on age, based on valuation of the home, and determines then the maximum amount that they can get in proceeds. During the course of the transaction, the borrower receives regular payments or periodic payments from the lender, or can make advances on lines of credit. So unlike a forward mortgage, a reverse mortgage is going to pay out to the borrower rather than the borrower making monthly mortgage payments. And those are called term and tenure payments. A term payment is over a specific period of time for a specific amount of money. And a tenure payment is a payment for life. For as long as they occupy that property, that payment is guaranteed to be in their hands each and every month. There can also be a line of credit, much like a HELOC, associated with a reverse mortgage or HECM loan. And unlike a HELOC, it's established, and the line of credit grows. It grows on a regular basis. It's not subject to property value. It's not subject to future appraisal value. So the line of credit on a HECM is a pretty interesting tool, and it's getting a lot of attention with the baby boomers today, and we'll talk more about that. So as long as the borrower occupies the home, the loan does not become due and payable. But once the borrower dies or defaults or doesn't occupy the property, then what happens is that the property is sold by the estate to pay off the loan. Or, if there is no estate, the property is acquired by the lender and sold, and there is no recourse on this loan whatsoever. So remember, on a HECM loan, and it's received kind of some bad press over time, you'll never owe more than what the home is worth. And so if the property is upside down, if there's been more advanced on that home than what it's worth, it's going to be liquidated, and then the servicer is going to make a claim with HUD against the MIP fund. So that kind of gives you a 40,000-foot view of how a reverse mortgage looks. Now let's take a look at the product a little bit on the next slide. So the features of the product, and there's more than this, but there's no monthly payments, right? So that's the primary feature, and it's primarily being utilized to extinguish existing mortgage debt. So a reverse mortgage pays off an existing debt, and there are no payments. In addition to it, there can be payout of equity over time, or like I said, on a line of credit. What's getting a lot of attention about a reverse mortgage today as a feature is the purchase money feature. So we'll talk a little bit more about that, and we've got some statistics And probably getting some good inquiries today if you're working with realtors about the HECM for purchase. Borrower eligibility, like we said, is 62 years old, and the debt is going to be against the primary residence. Eligible properties are 1 to 4 units, including HUD-approved condos and manufactured. HUD counseling is mandated, and this is an important feature, and this is when we're talking about implementing the product in a company, the HUD counseling is it's unique to this product, and the network of HUD counselors and their role is very important in counseling seniors about the reverse mortgage product they're about to enter into. The product's evolved. It's probably evolved more in the last 24 months than in the last 24 years. There have been a rapid amount of changes made to the product to make it more mainstream, more consumer friendly, to protect the MIP fund, and actually to protect the opportunity to keep a senior in their home for their lifetime. Servicing, like I said earlier, unlike a forward service loan, the servicer is going to make monthly distributions to the borrower, and the servicer is going to honor line of credit advances and possibly plan modifications. A HECM can be refinanced into a new HECM, and we've seen that happen from time to time, especially for a lot of seniors that maybe got into a HECM during the last credit crunch, and as their property has increased in value, they've gone into a new HECM to establish a new maximum claim amount. Let's take a look now in an interesting comparison, I think, of forward versus reverse on the next slide. So on the left side of this slide, we have our forward mortgages. And Beverly, if you could just move the slide up one more for us. There we go. Thank you. On the left side is the forward mortgage. The right side is a reverse mortgage. So the purpose of the forward mortgage is usually to purchase a property or refinance. On a reverse mortgage, the purpose is to generate cash or purchase a property. On a forward mortgage, prior to closing, the borrowers usually have limited to no equity, small down payments. On a reverse mortgage prior to closing, the borrower has significant level of equity in the property. On the forward side, you must have sufficient income to debt ratio to qualify for the loan. Now on the reverse side, financial assessment that's coming into place is going to look at the income and credit worthiness to support and maintain mandatory housing and living expenses. So this is something new for our industry. Prior to that, it was just basically the equity in the property, qualifying as age, and you got a reverse mortgage. But I'm going to stop here and just talk a little bit about some of the bad press that the industry's had, which is tied up with T&I defaults, right, where seniors went into reverse mortgages and then couldn't maintain the terms of their deed, which was to make their property tax payments, maintain the property, maintain insurance on the property. Now financial assessment comes in and says, we're going to look at the borrower before we grant the loan to make sure from a disposable income approach, like an FHA manual underwrite on the forward side, to make sure that they've got enough residual income before we put them into this loan that they can pay their property taxes and insurance. And if they can't, then we're going to do a set-aside. We're going to take some of the proceeds now out of the reverse mortgage and do a set-aside in servicing to make those payments, those property charge payments for them. So this is an interesting change to the industry. It's a good change. It's being embraced by everybody. But it's not driven by credit score. There are no debt ratios. It's simply looking at the income, looking at disposable income after deducting for typical members of the household, a national chart of charges for living expenses, minus the property tax insurance and other mandatory obligations on the property. On the forward side, during the life of the loan, the borrower makes monthly installments, the loan balance decreases, and equity increases. During the life of a reverse mortgage, they're going to receive monthly payments, the loan balance is going to increase, and the equity gets reduced. Gets reduced maybe to zero, maybe not, may get into a situation where there is no equity, and in fact the reverse mortgage balance could exceed the value of the property in the future. And if that's the case, then actually the reverse mortgage has done exactly what it's supposed to do. It's kept the senior in the home, regardless of how long they lived in that property. And again, it's a no recourse loan. So that if the property was upside down, after all the advances were made of 10-year term payments, lines of credit, whatever you have, it's going to be a claim to the MIP fund, and there is no debt for the heirs to worry about. On the forward side, then you've got falling debt, rising equity. On the reverse side, you've got rising debt, falling equity. On the forward side, the amount borrowed is determined by requirements for income, creditworthiness, and appraisal. On the reverse side, the amount borrowed is determined by age, current interest rate, and value of the home. There's no credit scores. We're not looking at debt ratios. Financial assessments in place to help us make sure that we determine whether the senior is going to need set-asides or not to make their mandatory property charges. On the forward side, counseling is not required, and on the reverse side, HUD mandated counseling is required. Let's turn to the next slide, Beverly. And we're going to drill down here in some detail because it's important. And again, I don't want to sound like I'm pitching a product, but if you don't really grasp all of the moving parts of a reverse mortgage, you're not going to understand all the moving parts that's going to be required of you, your company, your compliance, your trainer, your capital markets. And there are a lot of moving parts here. So, this is going to get a little technical. My first bullet point says that the product has a national lending limit of $625,500. That's the max claim amount, MCA. We spoke about that earlier. Not the biggest loan in the world. Loan amounts determined by the HUD PLF, principal limit factor, and it is a factor. It's a factor based on age, based on value. It's a factor that requires you to have a calculator that's usually tied into a loan origination software that's not part of the forward world. And we'll talk about that some more. The product's good for single family, 2 to 4 units. Kind of always that interesting. I get a lot of questions, 2 to 4? Yeah, 2 to 4. So as long as it's the primary residence, you could also be generating income from the other units as long as it's owner-occupied. It's good for refinance, and I would say in the last 18 to 24 months, what's really kicked in is the purchase. And we're going to see some stats here that help support why this product's important in the purchase world. Minimum age 62. There's now protection for eligible non-borrowing spouses. We talked a little bit earlier about some of the bad reputation that the product received because a lot of seniors weren't able to maintain their property taxes or maintain the property or property charges, and then were in default. And usually servicers worked really hard to keep the borrower in the situation, but there have been foreclosures tied to default in the terms of the deed. One of the areas that was changed on all this is that many times a spouse doesn't go on the reverse mortgage, okay, and they weren't protected. So they were kind of shoved out of the property, so to speak, if it was foreclosed on. Now there's protection for non-borrowing spouses that they get to stay in the property. If they're not on the note, they won't have the benefits of drawing any more money, but the loan is not going to be called due and payable, and they're going to be able to stay in the home. So this is a recent change and a big change for the industry. It was a big change implemented by HUD. There are no monthly mortgage payments. Taxes, insurance, and other property charges must be kept current, and the property must be maintained, and there are inspections. There is no prepayment penalty, and that's important. I mean, think about it for a moment. When you start talking to baby boomers who see lines of credit opportunity on a reverse mortgage, just because there's no payments doesn't mean you can't make a payment. You can go ahead and pay down that line of credit so it becomes reusable again. It's a non-recourse loan. I want to emphasize that. I talked about that earlier. Mortgage insurance is required. HUD mandated counseling. And the reverse mortgage comes in a fixed rate or an ARM. And a fixed rate is a single disbursement. All the benefits and features that we were talking about, a line of credit, 10-year or term payments, do not come along with a fixed rate mortgage. However, on an ARM, a LIBOR ARM, then you can set up where you have multiple distribution options. Like we said, a 10-year payment or term payment and or a line of credit. And some of those can be combined. You can get a payment for life and a line of credit, or a 10-year payment and a line of credit. A fixed rate, though, is single disbursement at the close of escrow, lump sum distribution, it's over, right? So at that point, they're not going to be drawing out any more equity. So you can probably see that the ARM is a relatively far more popular option than the fixed rate. Rather than credit and income-based underwriting used in traditional mortgages, a borrower's age and the amount of equity in the home are the primary factors used to qualify for a HECM. So even though I've talked about financial assessment, this is still an age and equity type of product. Financial assessment of income and credit histories to support and maintain the property is kicking into place at the end of April. And again, it's not credit score driven, it's not LTV driven, it's not debt ratio driven. It's driven by age, equity, and then disposable income to support mandatory property charges and minimum household expenses. So let's flip over to the next slide, Beverly, and just let's talk about benefits a little bit. The primary benefit of reverse mortgage is to pay off existing mortgage debt, extinguish the existing mortgage debt, and have no payments for life. I mean, that's the primary reason. And that's probably the largest percentage, vast majority, is simply, I want to pay off my mortgage and not have a mortgage payment. However, as we mentioned, you can have access to remaining equity through lifetime payments like term payments and or the line of credit. There are no monthly payments for as long as you live in the home and continue to meet the property obligations like taxes and insurance. There is minimal out-of-pocket expenses at closing. Counseling and appraisal fee are usually the only two out-of-pocket. Otherwise, everything is financed. Next slide, just to continue a little bit more. Loan proceeds are not taxable, excuse me. Social Security and Medicare benefits are not affected. You'll never owe more than what your home is worth, even if the home decreases in value. When it comes time to repay your loan, that's the no recourse. You and your heirs may have an option to cash out at any remaining equity after the loan is paid off. So, when it's time to liquidate the property, if there's equity, the heirs can certainly refinance or pay off the loan or sell the property and take the equity. Let's get on the flip side of this benefit, and on the next slide start talking about some of the perceptions out there, because this is important when you're evaluating the HECM product. And I have certainly presented to different groups within industries who have said we're opposed to reverse mortgages. And when I ask the question, there's some good reasons, and then there are some not so good reasons, some perceptions. So let's just talk about some of the perceptions out there. The loan balance increases over time as interest on the loan and fees accumulate. Well, we're all mortgage professionals, so we call that what? Negative amortization. We understand that, but for seniors, it can be a little scary. As home equity is used, there's going to be fewer assets available to leave to your heirs. And I do think that this is kind of a generational thing that I see changing between the original older generation that served in the Korean War. They're a pretty conservative group. Looking at a reverse mortgage was kind of a last resort type of action, where today baby boomers are looking at reverse mortgages. Financial planners are looking at reverse mortgages, especially in light of all the HUD changes, and are kind of looking at it now in a more positive light. Access to additional funds can be limited during the first year, and this is an important change that HUD put into place last year. Rather than seniors just taking all their money at the close of escrow, there is a waiting period, and it is 12 months after the transaction is granted before you can access additional equity. and that was put into place by HUD to make sure that the equity would be spread more over lifetime, and for the primary purpose of the loan is to maintain a senior in the property. Mortgage insurance costs may be substantially higher on low equity scenarios. In other words, the MIP increases when you have mandatory obligations that exceed certain, I would call it from a forward term, loan to value, but low equity scenarios. HUD designed the reverse mortgage to, number one, extinguish mortgage debt. But when that mortgage debt is high in comparison to the home value, just like on the forward side, the mortgage insurance increases. A few more perceptions on the next slide. Eligibility for needs-based government programs such as Medicare could be affected, and that's important to know. The loan becomes due when the last borrower or eligible non-borrowing spouse no longer resides in the home, or the home is no longer the borrower's principal residence, or the borrower vacates the property for more than 12 months. So you've got some triggers, and these triggers could be problematic. The loan is in default when property obligations are not paid, or the property is not maintained per the terms of the agreement. And that's where, you know, some of the, I think, headline news that we get in reverse mortgages, which honestly is no greater on the reverse side than it is on the forward side for a percentage of loans that are made, but we are dealing with the most protective class of citizens out there, the senior citizens. So it becomes headlines. And I'll tell you from a servicing standpoint, everything is always done to the maximum extent possible to make sure that a default doesn't exist for a senior. But it does happen. Let's go to the next slide and look at some statistics that can kind of help you decide whether you're in the market, whether this is going to complement your menu of products or not. And here's an interesting one. Kind of blows your way. The reverse mortgage market is about 1% the size of the traditional, you know, billion, trillion mortgage market. The number of reverse mortgage originations, however, is likely to increase in the upcoming years as the baby boomer generation, those born from 1946 to 64, begin to retire, begin to go into age 62 or retire. And this is the age group that you know, is more open to the benefits of a reverse mortgage versus the previous generation. 41% of Americans aged 55 to 64 right now have no retirement savings. That's scary. That same group has a home ownership rate of 74%. That's interesting. Homeowners aged 62 or older hold a combined $3.8 trillion in equity in their homes. Well, what does that tell you? They're going to have to tap that equity to supplement the lack of retirement savings, and they do it one or two ways. They're going to do it either by selling the property and downsizing. That's one way to do it. Or to tap into their equity if they have the credit worthiness from a forward side, but they'll be obligated to make mortgage payments then. Or what's being suggested by financial planners today is utilization of reverse mortgage as part of that financial planning tool. Always like this number. 10,000 people turn 62 daily. Wow, right? So I was one of those last week. I turned 62 last week. So on my birthday, 10,000 other people joined me in turning 62. I guess you're asking yourself the question, am I going to run out and get a reverse mortgage? Not quite yet. There's also 23 million households that qualify for reverse mortgages. 6% of those 23 million households are going to relocate. 20% of those are going to use mortgage financing, and we've estimated that annually is about 276,000 potential reverse mortgage purchase transactions. And if you haven't heard about it yet, the National Association of Realtors has entered into a conversation about reverse mortgages, and I think anybody with a retail group of loan officers that want to have a new message with their realtor referral group, a reverse mortgage is a very interesting discussion. It's not used all the time, but when you can use it, it's pretty darn interesting to acquire a home with a fairly healthy down payment, somewhere upwards around 40%, but not having a mortgage payment after that's kind of very interesting, especially when downsizing. So on the next slide, Doesn't look like a lot, but there's a lot to talk about here. So I'll go through this. I want to talk about kind of the tactical and technical sides of considering to bring a reverse mortgage product on. To start off with, the HECM's a great recruiting tool. And I'd never thought of this, but as I've talked to a lot of forward CEOs in the industry, the HECM, more loan officers are looking at companies that allow them to broker or bank reverse mortgages. And we'll talk a little bit about the difference between those. So I never thought of it that way, but a HECM is a great recruiting tool when you're looking for new loan officers. It is growing. Loan officers are looking to expand their book of business. The product is 3 to 5 times more profitable than a forward mortgage. And I'm talking about lender paid compensation or gain on sale if you're a mortgage banker selling these loans. 3 to 5 times more profitable historically than a forward mortgage is something to seriously consider. However, it shouldn't be the sole factor, sole reason when you are considering bringing a reverse mortgage product on board. In fact, something to consider on this one is the turn time, the pull-through, the amount of time it takes to do a forward versus reverse mortgage is also about 3 times longer. And it isn't the processing time. It isn't the appraisal time. It is taking the time to work with the senior and, in many times, work with the potential heirs of the senior in considering whether or not to take down a reverse mortgage. Add to that counseling time. It's not that it's hard to get a counseling appointment, but it's a piece of the process to get a borrower into a reverse mortgage. And I want to tell you something. A lot of people just don't understand selling reverse mortgages, and it's just that alone. They try to sell it. And a reverse mortgage isn't something you sell. A reverse mortgage, you advise. You become an advisor. You're actually investing time with the senior and their heirs to help make a decision and then how to structure. I mean, it's one thing to say, yes, it looks like a reverse mortgage is a good idea. Go into counseling. Make sure your questions are answered by the HUD counselor. And then when you come out, designing the product so it performs the right way. Do you want a 10-year payment? Do you want a term payment? How much should that be? And the whole, we'll talk about it in the morning, LOS technology designs this, and it becomes a really interesting tool where, the forward mortgage is just kind of straight and simple and forward, where the reverse mortgage you have a lot of options. So my point is that it is historically profitable. That's great. It's good news, 3 to 5 times more, but it's also going to take a little bit more time, and you don't sell a reverse product. A reverse product is something that you take your sales hat off and put on a advisor's hat. It's a versatile product. I'm going to tell you, there is no product like a reverse mortgage anywhere. This is a versatile product, and this is widely used in Europe as well. This product helps expand market opportunity when working with referral sources like realtors and financial and wealth advisors. And we personally believe in this financial planning sector right now as they adopt this. I mean, obviously, they've got benefits in promoting and using a reverse mortgage because it helps cash-strapped clients for wealth advisors. More senior lending options. As your book of business ages, this product provides additional lending options for seniors. Really, what do you do with a senior who has limited income now and needs to tap their home equity? You're not going to go to a bank, and you're not going to go to get a line of credit unless you're credit worthy enough and have income to approach it. And quite frankly, the retirement benefits just don't cover that anymore. So if you haven't looked at a reverse mortgage, it's probably good when it comes to servicing your existing book of business and having options, additional options as your book ages. So listen, all this good news does come with a cost. And on the right side of this, looks like, yeah, I'll train to it, I'll market to it, but each one of these categories has its own challenges. Training loan originators on reverse mortgages is critical. And I'll tell you, this is where your company can get itself into trouble or can do something valuable like offering a reverse mortgage to a senior. It starts with the loan officer. It starts with their training. Not every loan officer is going to want to train to this. These aren't like doing refinances, just churning them one after another. These take time. They take investment. They're profitable for a reason, right? And not all loan officers are worthy of this. And really, you should consider a credentialing process, a certification process for loan officers who do want to offer this program, because you don't want a loose cannon out there working with a protected class of citizen such as seniors. So I recommend that you work with your lender investor that you've chosen, and they all have great training programs, and that you require training and certification before your loan origination staff goes out there. I've seen some very, very successful scenarios where maybe in each region or each branch there is a reverse mortgage specialist, and the other loan officer will refer into that. And that way you can kind of closely keep watch over the origination process of your reverse mortgages, and then expand from there. In fact, I also kind of recommend that if you're thinking about banking the product as a mortgage banker, you might want to first start brokering the product, right? Get comfortable with the training, get people trained, deployed on the front end before you have to do too much training on the back end. Speaking of the back end, it's a different processing scenario for your processors. If you're going to bank the product, there's extensive back office time. It does look like, and in any time I'm looking at a company that is interested in reverse mortgages, it's always kind of a comfort for me if they have forward FHA experience, because a lot of the back end or processing of a reverse mortgage looks a lot like the back end of a forward mortgage, case numbers, remittance of MI, insuring, things like that. Marketing is a whole nother aspect of this transaction, and it's not sold, as I said earlier. So marketing for this transaction is usually referral-based. This is a people-to-people product. This is not an interest rate product. This is not something that you post in the newspaper that you've got the lowest reverse mortgage rate out there, right? You don't see a lot of that. You do see a lot of, if you just Google reverse mortgages on the internet, you'll get a ton of hits, and they're usually all based around the cost, the closing cost. Because of the profitability, a lot of marketing is spent on just paying borrowers, some of the borrowers' closing costs on the transaction. Marketing is something that's done through the referral source. Like I said, the realtor, the HECM for Purchase is growing. The wealth financial planning referrals are growing. So it's, and the other thing that's growing out of the industry right now is lead generation. And there are companies that specifically work selling senior leads, and it's just like the forward side. You got to vet the companies. You got to know what you're getting into there. But just posting an ad in a newspaper that you've got the low reverse mortgage rates would be misleading, number one, and number two, it's not going to get you any business. One of the other big areas is the whole technology. There isn't a forward LOS system today that I know of, and I don't think exists out there, that does the calculations for you, that populates and processes all of the necessary front-end disclosures, application packages, and closing docs on the forward side. So you're going to have to make a decision to adopt an additional piece of technology. And of course, you know what happens when you do that. Now you're running parallel systems, and you get down to urine, your HMDA data, and all that stuff. There's lots of technical considerations on a reverse mortgage, which alone have kept a lot of originators out of the business. There's tons of proprietary software out there offered by the reverse mortgage lenders. There's also a couple of private reverse mortgage technology companies as well. So there's plenty of technology out there. But again, you've got to think about the technology just as much as you're going to think about the training, because they work hand in hand. A lot of the training is going to be based around the technology. The technology has to support the origination effort and the processing effort. So you're going to spend a lot of time and effort to make the choice of using the right piece of technology. Every lender will say, use mine, use mine, use mine. and there's considerations why you could, maybe should use a investor lender's technology, and I can come up with a bunch of reasons why you don't. So it just depends. It depends how much you want to invest in it, whether you want free technology or you want to own your own technology. Lots of considerations there. We talked a little bit about operations integration. If you don't have any government experience, you're probably going to start off brokering these transactions. Nothing wrong with that at all. You might be leaving a couple hundred basis points on the table, brokering versus banking, but you still won't be disappointed with the profitability of the product. And it's a great way to get started. And then if you're thinking about banking the product, every investor out there has a PA program, principal agent program, where they'll do the underwriting for you. And that's great because then you don't have to go out and get your HECM DE. You don't have to go through that. And your investor who's going to buy the loan from you will do the underwriting for you. Again, it's probably always good from training, origination, marketing, technology to take a bunch of baby steps getting into this business. I have yet to see a large forward mortgage lender take down a complete mortgage banking proposal and accomplish that all in one fatal swoop. They take it and just chew off little bits at a time. Get the origination piece of it done by brokering, get the training to support that, use the technology from the investor who you're going to broker to, and then start building on that. Once you get going with the reverse mortgages, you won't turn back. But it's starting small and working your way up. Of course, capital markets, there's a whole nother scenario, obviously a call to your warehouse lender if you're going to bank the product. Investor authority, and we spoke about being a broker correspondent. And, you know, we could talk probably another 15, 20 minutes, and I won't do that to you today, about compensation plans and compliance. And another lot of really good reasons to start off as a broker versus a banker. But listen, if you're attending today's webinar because you really did want to bank the product, good for you, right? There are plenty of companies that have come in and support you and work with you through that effort. So I don't want you to scare away, but I do think starting off as a broker is a good way to go. Let's take a look at the next slide. And I want to be very concerned about our time and your time today. Integration. So let's talk about this integration, and I kind of wanted to come up with a kind of a view here of what it looks like. You're going to have to decide what your distribution network is going to be. For most of us on the phone today, we're probably talking about offering reverse mortgages to our retail loan officers. But you know, the industry, if you're HUD approved and you want to bank these and become your own lender on these, you know, I have seen over the last, I'd say 4 years, more companies grow up and start small and then turn out to be, frankly, some of our competitors. We've grown some originators into some of the top originators today, only to turn around and then get into the B2B side of the business, start offering the business to their broker network and then their correspondent network. Credentialing, we spoke about credentialing, making sure that your distribution channel, whatever it is, receives adequate training, because this is where you're going to get in trouble, right? Putting the wrong people with the wrong product is going to be a disaster. So we highly recommend a credentialing program. Most of your investors out there today, lenders out there today, will assist you on this one. We're big proponents of this one, and you're going to want to spend a lot of time in the whole training and credentialing process before you start writing your first documents. Technology, you can't run away from it. You've got to embrace it, and depending on how you're going to start, it's a big decision here, because once you're into reverse mortgages, you need a very dependable piece of technology that's going to be there, one that's compliant, because you know well today, all of your disclosures are driven by technology. Your operations team, if they don't understand the reverse mortgage like your origination team, probably your next area of getting into trouble is in the back office training. Starting as a broker, moving into a PA correspondent relationship before becoming a closed loan seller, if that's what you're considering, or is probably the best way to tackle that one. We've talked about training, and then we've also spoken about marketing. So this is kind of an integration wheel that I've used before, and it's actually not just for reverse mortgages. This is anytime you're going to offer a new product or a service, kind of keep this in front of you. These are the components that you're going to have to address to make for a successful launch of any new product. My last slide is kind of something I'm going to leave you with before we go into any questions that you might have. I want to thank you for taking the time to attend today, and we're going to answer some questions if you have some. But I want to leave you with some thoughts and conclusions here. The HECM may not be right for every borrower, and that's important to understand. The HECM may not be the right loan for every borrower. The HECM may not be the right product for every lender. The HECM is unique. There's no other product like it. That uniqueness causes a lot of training, operational headaches. When the need exists within the organization, the HECM, or the reverse mortgage program, expands that opportunity. The cost of implementing a reverse mortgage program in your company may outweigh the benefits, and I've seen this. We should talk about that if that concerns you. However, just the opposite is true. The cost of not offering the HECM may be immeasurable. So I want to thank you for attending today. I'm going to turn it back over to Beverly to see if we have any questions.
Thank you so much, Garrett. That was a lot of great information. We do have a lot of questions coming in. I don't think we're going to be able to get to all of them by the end of the webinar, but please keep sending your questions in. We'll try to get to as many as possible. And I've been getting a few people asking if we're going to be sending out the slides. We are going to be sending out the slides and a recording of this webinar to everyone who registered. So if you know someone who registered and couldn't make it, they'll still be able to see it, and you'll be able to review it again. All right, we're going to get right into these questions. The first question, can two borrowers be unrelated as long as one of them is 62 years old? For instance, if there are two friends who want to do a HECM loan.
So Pat, I'm going to turn all these questions over to you because you're the subject matter expert.
All right, thank you, Garrett. Okay, question. Two unrelated people and one is not 62? Was that the question?
Mm-hmm.
No, both of them could not be borrowers. The only way you'd be able to have someone as a non-borrowing spouse would be a non-borrowing spouse if they're not 62. Each borrower must be 62 years of age in order to qualify and be eligible for a HECM loan. If, unfortunately, they are unrelated, only one of them can be a borrower, and they would not be qualified as an eligible non-borrowing spouse.
Okay. The next question, can someone with a HECM purchase and finance a second home with traditional financing, and how is the HECM used in ratios?
The HECM is used only for their primary residence. HUD only allows someone to have one FHA loan at a time unless going back years ago to forward underwriting guidelines. If you had an old FHA loan and through a divorce, that loan was, and that house was awarded to an ex-spouse, or back in the really, really old days, and I'm going to date myself, when you had a job transfer, or if you had a home where your household size no longer was acceptable for the size of house that you were in, and you chose to keep that home and move on to another one. So no, you can only have technically one FHA loan at a time unless you meet certain criteria that is HUD's guidelines. And I'm sorry, what was the other part of that question?
Well, it was just if they have a HECM loan, can they get a regular loan, basically, on another property?
Again, they can get a conventional loan.
Right, but not FHA.
Not FHA, yes.
Got it. Okay. The next question: can a snowbird get a HECM loan on their home if do the 12 months have to be consecutive that they're in the home?
Okay, HUD's guidelines on a HECM transaction is that the property, the primary residence, must be your primary residence for at least 6 months and 1 day out of the year. So you can have people who are snowbirds who winter in warmer climates for 3, 4, 5 months out of the year. However, they must continue to maintain the mortgaged property as their primary residence. And we always recommend, because your servicer will do occupancy checks on a yearly basis, to notify the servicer when you're going to be vacating the property for any length of time. And that could mean if they're going to be a snowbird and go to a warmer climate, or a lot of seniors have to go to a rehabilitation facility for a short period of time, maybe 3, 4, 5 months for rehabilitation purposes. Again, that's acceptable too, providing if they're in a rehab center that their intent is to move back into the home as their primary residence. If, however, they've been in a rehabilitation facility for 12 months or more, then the loan will become due and payable, because at that point, it's basically considered that they're not going to be able to go back to their home as their primary residence.
Okay. The next question, does a lender have to be FHA approved to do a reverse mortgage?
Okay. Do they have to be FHA approved? They can be a broker, and we can be their sponsor if they don't have full FHA authority. Now, if they have FHA authority for forward loans, there is an approval process that those same FHA-approved lenders have to go through to be HECM designated approval also. They have to do 5 test cases to get their HECM designation. So it all depends on what they want to do and how they want to perform their business, if they want a broker, banker, what have you.
Okay. What is the average time from the initial contact with the borrower to the closing of the loan?
As Garrett had indicated in his presentation, these do take a little bit longer than a normal forward loan. From the time of initial contact with the senior to the time the application is taken. Once the application is taken, basically it's the same time frame as it would be for a forward loan. However, again, as Garrett indicated, we're not selling these loans, we're advising them. It takes a senior a little bit more time. They discuss it with their children, with trusted advisors, with their attorneys, what have you. So that portion, time frame, depends on the potential borrower and their decision-making process. But from actual time of application to time of closing, it's usually somewhere between 30 and 45 days, like it is on a normal forward loan.
Okay. What would happen if one of the borrowers had to be placed in a care center for treatment for over a year, and their primary residence was still the home, but they were in a care facility?
If you have a married couple and and they're both borrowers, and one of the borrowers is placed in a facility as their primary residence now, they're still okay as long as one borrower continues to live in the property as their primary residence.
Okay. The next question. Seems like a HECM is similar to a HELOC, so what are the differences between them?
Well, for one thing, first and foremost, a HECM, you do not make any monthly principal and interest payments. A HELOC loan, you're going to make monthly payments, whether or not it be interest only, and then a few years, 10 years down the road, your HELOC will then recast and your payment will go up greatly. Your borrowers may not be able to afford this. There is actually qualifications. There's specific loan to values. A HELOC is normally a second lien position loan. A HECM is a first lien position loan. And again, remember that there are no payments on a HECM loan where there are payments on a HELOC. In addition to that, if you have an adjustable rate on your HECM, you can have a line of credit. As long as that line of credit has not all been used, your line of credit will never be cut off from you. We've seen recently in the last 10, 12 years, a lot of people had HELOCs, and even though they had still lines in their HELOC, they were cut off because of the values of the properties decreasing. On a HECM, your line of credit, unless it gets to its limit, its maximum, will never be cut off.
Okay, great. We have time for one more question, and then we're going to close up the webinar. How is the down payment calculated on a purchase transaction?
The required investment, not necessarily down payment on a HECM for purchase, is actually calculated the same as it is on a HECM traditional loan. It is, again, based on the max claim amount, and in this particular case on a purchase transaction, it would be the lesser of the purchase price or the appraised value, the age of your youngest borrower or eligible non-borrowing spouse, and your expected rate. So in all cases on a HECM for purchase transaction, the borrower does have to come in with cash at closing. But again, the principal limit there is calculated the same way as it would be calculated in a regular traditional HECM refinance transaction. There are no loan-to-values per se.
Okay, great. Well, I wanted to again thank Reverse Mortgage Solutions for sponsoring our webinar, and thank Garrett and Pat, for both of you, for the great information that you've provided to our audience. And if I did not get to your question, because there are several questions that we did not get to answer, I will make sure that Reverse Mortgage Solutions gets your questions and that someone will try to get in contact with you to answer them. And with that being said, I just hope everyone has a great rest of the day, and I will see you on the next webinar.
Thank you, Beverly.